Right, here we go. It's Tuesday, Tuesday night Australian time, Tuesday morning US time. US market's about to open. Here we go. This is the S&P. So having like my core underlying portfolio always has been, always will be long and leverage, right? So for me, when I am looking at trading on a shorter term basis in the technicals, I'm worried about these kind of pullbacks that are not only big, but they last a long time. Okay, this little one here, that was a bit of a worry, but in the scheme of things, it was not a big pullback. Certainly not something that fits in with breaking normality. I said normal, change to normal. That was .com. Normal, right? GFC, change to normal. Normal. So really I'm looking for the catalyst is going to be the change to normality that it will I guess would put my portfolio at a threat of stagnating for some time. Now, one of the things that concerns me is the valuations that are up here. Okay, because when I look at what was normal here, and an indication that it was was unsustainable, was the old Shiller PE ratio. So the last time we've seen a PE ratio on the Shiller PE ratio, look it up, it's quite useful, was back in .com days, right? We haven't seen a high ever apart from .com. This is not a good sign, right? Even just on the S&P500 ratio, it's still very high, right? Now, those PE ratios, they're built on essentially two things, those high PE ratios. One is hope, right? Hope that the earnings will recover. Two, they're based on low yields, because obviously the lower yields affect all kinds of things in the valuations of equities, and you've got like a lower yield, then your PE ratios are naturally going to shoot up, right? So when I look at where we are here in terms of these extended PE ratios here and here, they are built on two things: hope, right? This was hope and low yields, right? So when we go and look at the yields, we see something that to me is a potential warning sign, right? Okay. So this is the 2-year yield. So you can see there's a long-term trend line, structural decline in yields, because as they go down, people gear up. You can't raise them as much, right? This is the old .com burst, right? The yields came up to this trend line, and that was one of the things that helped pop that bubble. High yields make those PE ratios look stupid, which they are, okay? And then the hope disappears, the markets crash, 45% fall it was here, and the yields kind of scoot back down. They come back up, right? They come back up, the GFC, right? That's the next one, right? That had a 50% fall, okay? And it came back down. This one, this is a bit of a lesser fall. This was the end of 2018, so that should be 2018, when there was a 20-something% fall. That was like a few things, there was Powell, I think it was Powell, wanting just to normalise rates. There was whole US trade tensions with China. There was also a big bust in Bitcoin, particularly at this point in time, but also in the lead up to it, right? So what I'm wary of is these yields coming back, just as they have here, just as they did there, just as they did here, and creating a pop, right? Like in .com, in the GFC, or in this kind of basically whole, I don't know, whatever you'd call this one, I don't know what people label it, crypto sell-off, whatever. But they were 20, 50 and 45% falls. They were sizable falls. Now, one of the things that I'm concerned about here, of course, is the oversold. This on the monthly is very heavily oversold. Now, often that means that these things going to spring back quickly, faster than normal, right? So it could come back like as soon as the end of this year. Okay, I think it could be longer. It could be like 12 months. Right? But I reckon sometime in the next like 3 to 12 months, these rates are going to come back to this trend line, possibly higher. Okay, that is going to do some real damage to the P ratios, just because higher interest rates will damage those extended P ratios, but it will also dent the hope that those things are pinned on. That's what I got my eye on at the moment. Now, just coincidentally, I don't talk about Bitcoin that often because it is, frankly, a bit of a joke in my mind. But when we look at Bitcoin and what happened in 2018, right? This was 2018. So just at the end of 2018, there was this little move, right? 49.94%, right? The overall move was 84% over that 18-month, 2-year period. Back here, there was another one, right? The last time, and it was like 86%. Funnily enough, similar kind of patterns where it had a run up, formed a bit of a floor. Now these lower lows come down, and eventually it cracks, tumbles, recovered, sure, but from there to there it was like 80%. Same thing, he had a run up, formed this like these kind of lower lows against a floor, and it popped, and again high low 80 something %. Now, interesting thing about where we are there, and here is of course these monthly RSIs. Right, so if you kind of look at, if you're a crypto investor, which I am not, I mean, I think investor is a bit of a ridiculous word for being in a crypto, right? When these things were overbought, this time, right? Oh, hang on a second. Back here, it was a 87%, 86% correction, right? It took a while to get there, right? Okay, it was overbought for quite a while, so it might not happen for some time. There we go. 82%. Where would 80% take this little sucker, right? It would take it. No, that'd be quite neat, right? It'd take it down to 12,000, back to that previous line where it broke out from. Yeah, that'd be pretty amusing for me, really. Now, I guess the question is it going to do something like this, where it just has a little pullback and then have another big thing up? I don't think so. Is it going to do something like this, where it actually stays elevated for quite some time? Well, it's already been elevated for quite some time. I guess the difference is here, it's already broken down, and the divergence from this peak to there on a monthly is a massive negative divergence. So I guess just as that was a precursor and part of that correction to the market that we saw in 2018, where yields were rising, and that was one of the things that helped pop the party there, right? That might be something that could be a risk, the way I see it, for the S&P500, similar back to the .com. So I'm watching things like really the yields and their effect on the PE ratios that are going to bring these things down, and then some of the collateral damage that could be caused through a collapse in something as big as like Bitcoin and Tesla, right? Because Tesla, that valuation is like 400 or 500, which is just ludicrous. Bitcoin, of course, got no PE ratio, but between those two bubbles, that's $2 trillion, right? This .com thing, this was about $1.7 trillion just in the first few months, right? So $2 trillion in those two things having a sizable hit would really have significant repercussions. Now, as far as where I'm seeing the market at the moment, let's have a look at this. Let's go down to a daily. I guess I'm seeing a few things here. Now, one of the things, if you're watching people doing commentary, you've got to check whether they're looking at things on a log scale or a linear scale. Now, it is a little bit subjective, but it can make a difference. It's particularly subjective when you start looking at these trend lines, and it is a function of price and time, whether you look at something on a logarithmic or linear scale. If it's a longer time with bigger moves, you've got to have it on a log scale. If it's a shorter time frame, then it really doesn't make any difference, and people normally look at it on a linear scale. At the moment, this is probably touch and go for either way, but one of the reasons why it can make a difference is when you look at this on a linear scale, right? You know, there is this nice, well, there's obviously this nice trend line through here. There's a pretty good one around the top there, like parallel. And when you look through the middle here, you know, where it's kind of like buzzed around either side, we've just ticked above it, which some people will point to and say, oh, we've just ticked above that one, right? But if you look at it on a logarithmic scale, you know, you can actually say, well, we're coming up against it, right? So is it a resistance or is it a support line, right? You know, because, you know, you kind of look at it that way on a logarithmic scale, you know, and you go, well, really, this is coming up to a resistance, okay? You look at it on a linear scale, you know, and you come down here and adjust it again, and you go, well, actually, it's now support. Right. So if you're talking to people and they're looking at these trend lines, and particularly the back testing of them, just be a bit skeptical, because with a click of a button, you can make it look a potential bullish or a potential bearish signal, right? Anyway, enough of that rant. So this is really the basics that I'm seeing of the S&P at the moment. I'm still a bit skeptical of this run up. It's you know, it's kind of come back really on not a lot of news. I mean, there's been some good earnings, but you know, apart from that, not a lot of real kind of fundamental things to change the outlook for higher rates in the market. In fact, the earnings only go to reinforce the case for higher rates. To me, it was a bit of a knee-jerk reaction to that sell-off, and the money just came back in large. So I'm still skeptical. I'm still mindful of the overlapping nature of these, the last big correction that we've had, and pretty much all the other corrections that we've had here, where you have a run up, and you do have, maybe not overlapping a lot in that case, but you certainly do have these patterns of 5 where you go like 1, 2, 3, 4, 5, and it's overlapping. You get like a little pair of bottoms, pair of tops, pair of tops, pair of bottoms here. I guess you could say it's either a pair of tops there, pair of bottoms there. But here we've had the run up. We haven't had the overlapping leg yet to give us a bit more sanity for going higher. So as far as my technical analysis on this one is, I am wary, and I am looking to give this another shot at shorting for this leg down. I'm not sure when I will do it, but I guess I will look for something probably pretty imminently, given what's going on in the RSIs here, given the 4 hourly, that's what I like to trade off, given the way in which it has been rolling over. And I'll probably be looking at, you know, if there is a stab down here, then that would be a signal for me. So that's the US market. One of the things that I'm also a little bit concerned about with the US market is the old Dow Jones Transportation Index. Everything else is hitting new highs. This one hasn't. And look how heavily overbought it is. I mean, there are people who are talking about, well, the depth in the market or the breadth in the market for the rally is good. Apparently, I don't know. But this is looking very extended and toppy to me. that turns, that's not good for the broader market, particularly the old Dow Jones theorists. So that's the US equities. In the Australian market, I shorted it here, squared up down here, picked up just like cheeky 100 points. That was good for me. Did that close that out this morning. Similar thing to the US, where it's the trend is still up, and there are some maybe midpoint lines here that it hasn't come back to yet. The Australian market has certainly been weaker than the US one. This has certainly had more of the overlapping nature of that we haven't really seen in the US market, just by the fact that it hasn't gone up. There is a bit of this trend going on, which I'm mindful of, which to me still means this is looking still pretty precarious for the Aussie for a longer term break. The US is looking precarious for a pullback. I'd say high chances. This for a longer term break, looking a bit more high, but probability with a target of 7,120 on it. And I guess that's also a function of the RBA, the Central Bank in Australia, losing control of monetary policy. So where we are here in Australia, it is kind of broken or just on. I mean, that's the kind of line where it's at right now, right? That high through here. That's where it's sitting at the moment. And it's looking pretty sad, isn't it? Like, to me, it's looking like it's about to dump itself. So I've still got my eye on shorting that one. The Aussie Dollar, I've been short this again. I shorted it up here at 74.20, 74.15 it was actually. So sorry, 75.15. I shorted it out. It was just in here, 75.15. And that was really for a couple of reasons. One was top of this trend, like this one, the downtrend coming down here. So it was really at the top of that channel. I mean, again, you can really draw these things in so many different places. But it was the topish of that trend line. It was the top of this channel too, okay? And it was overbought and had rolled off on the 4 hourly. So that negative divergence. So for me, that was a bit of a triple whammy. So you can see here, weaker momentum, slightly higher price. Sure enough, it's come off. Hard to say how much further it will come, because it is now oversold on the hourly. Often for me, that's a sign to square up. One of the things I like to do is I'll sell on the RSIs when they're overbought or oversold. Sell if it's overbought in the 4 hourly, sell it. Then if it becomes oversold on the hourly, buy it back. Sometimes you miss out on a lot of big moves with that, but it is quite a safe little strategy. But you can miss out on some big moves. This one is looking quite precarious at this level. You can see just through here, there is a bit of historical, support resistance around through here. Bit of resistance there, tiny bit of support here. If you make it a bit higher, some support around there, bit of resistance support. So this level 74.60ish, bit of noise there. So I'm going to leave some pretty tight call levels in case it, mainly on the upside, in case it breaks through the upside. But I think given where the economy is going in Australia with inflation and the RBA saying it's going to raise rates sooner rather than later, I think the Aussie is looking a bit more of a sell. It's a tricky one, those rates raising, because on one level, higher rates should be good for our currency because the rate differential to the US is the spread is widened, so get back into the currency. The flip side of it is it means that the RBA is going to raise rates to slow the economy because of inflation, and that's bad for the currency, right? So it's a bit of a glass half full, half empty, having rates being raised, depending on how you look at it. I think this run up was based on the glass being half full, okay, like rates are we're going to get better yields out of the Aussie. It's come back here because it said, look, actually inflation is going to come sooner rather than later, and particularly with that CPI figure that came out last week, that was one of the things that kind of triggered the sell-off here. So that's the currency. Quickly in the gold market. Gold is really like, it's being a bit frustrating, really. I mean, it's just dicking around here. I still think it's doing this pattern of, as a bit of a ramp up, the highs come down, has a bit of a floor, which is a range, and I think it's in line to do, something like that. And it could then potentially do something like that, right? Which is really what happened back here, back in 2011, where it kind of went down. Eventually it came back up. Took a while. Took like 10 years or whatever, right? But I'll forget about that secondly. I do think that it is headed lower. And I think, as I've said before, there are a few factors that helped gold go up, right? And those factors have been dwindling, right? One was lower rates, right? Lower rates just make gold more attractive. Another one was just fear that the world was going to end. That was, in play as well. Those things have disappeared. I guess there was also the inflation factor. Gold seen as a hedge against inflation. That was a factor for gold going up because all these rates, these zero interest rate policies. So I guess there was those three factors. There was interest rates going to zero, which made gold more attractive just on an outright yield basis. Okay, so lower rates better for gold. Then there was the fear and panic thing. Okay, the whole pandemic thing, flight to safety. Okay, so that gave it a boost. And then there were low rates that can lead, and all the monetary money going in to stimulate the economy going to lead to inflation. That will punch gold higher. Now, 2 out of 3 of those things are changing, right? So the fear is gone. Okay, the world's not going to end. Interest rates are starting to normalise. Okay, so that hurts gold. Inflation is still a risk, though, right? Now, on balance, I think really markets are pretty clever at looking forward, and I think that the inflation trade, right, was here, right? I don't think the inflation trade is here, right? We've got inflation now, right? Gold went up here because of the inflation that we've got now, not the inflation that we're going to get coming down the track, right? I think if inflation really does spike higher, or it's already like 5% or whatever in the US, if it really does spike higher, that could see a bit of a resurgence. But I think that the market here was forward-looking enough to say back here, right, when all these, basically after 2018, we saw with the yields, when they went down, right, we go back to the old US 2-year yield chart, right? So 2019, all these rates started coming down, okay? You look at it a bit longer time basis, right? So when was that? That was like August 2018. These rates started coming down very quickly, right? So if we look at gold, Right. Let's go back to like the daily. You know, look at gold back in like, 2018. Well, that's actually, it was like August 2018 when they started cutting rates. That's when we started seeing gold make this final leg up. Right? So those lower rates, they make gold attractive on those two things. It's just lower rates and the risk of inflation. And then it was turbocharged like here, like in 2020, beginning of 2020, okay, with COVID. COVID's gone, rates are starting to go. 2 out of 3 factors that have support gold are gone. The third one, which is inflation, I think was really what was driving this move. It's not going to drive another leg higher. I think gold is a sell, and I think I'm going to. I had shorted it down here, was a shit level. Stopped out because it was just getting a bit of a pain in the ass. But I'm going to look for another good level to sell it at. It is a bit of a tricky one though, because I'm not sure. I'm not sure about the execution for where I get in on this one. On one level, I could say that the time is very near. Okay, because it's broken this trend line, and the next move will be down to 1720. It's had this touch of this trend line up here. And similar to the Aussie dollar, it's overbought on those 4 hourlies, 18.12. It's still kind of hanging in there. I think it might be time to lob a little out, and we'll see what happens. Let's see what's on the daily RSIs. Yes, it hasn't really been overbought on the dailies yet. But to me, I guess what I'll be looking at, I'll have a think about it, but I think what I might do is short one, have a stop above this trend line, probably 1830. That would be the stop. That would definitely be the stop, actually. Yeah, I think it's a good short at 1800, stop 1830, target first stop 1716. That wouldn't be too bad. Yeah, if we've got set at 1800, it's at $80. $80, risking 30. Yeah, not too bad. I might have a look at that in the morning. Look, I think that's pretty much it as a bit of a ramble on the US markets. But the recap is the S&P, it hasn't overlapped. I expect it in the short term to have an overlap. In the longer term, we are at some very extended levels. Right at the top of these trend lines. We just wipe out some of that noise. Right at the top of those trend lines, which is the same as what was going on back in the old .com days. Okay, boom, boom. They're driven by record high Shiller PE ratios and just the S&P ratio as a whole. And the US bond rates are the canary in the coal mine to watch for a trigger, and they have already started to move. Okay, they're coming off a heavily oversold base. They can move very quickly as soon as towards the end of the year. So it's like got 3 months, something like that. Anywhere between 3 months and I'd say 12 months, these rates are going to normalise. That's going to present a real challenge to the PE ratios. And just as we saw a move in the .com when rates kind of came back, in the GFC, these rates came back, and that 20% sell-off in 2018, we could see anywhere between a 20 and a 50 fall or normalisation in the S&P to bring it back to sensible levels. That's my long term and my short term. Okay, catch you later. Ciao.